Hi everyone. Okay, let's talk about the contribution margin. So as I said before, it's just looking at your income statement a little bit differently and grouping all of your variable costs and then your fixed costs together. Okay, so in this case, the two variable costs that they have, the direct material and the direct labor, are the exact same thing as if we wrote it as cost of goods sold. In this case, it sounds like because they have what's called direct labor, as in this is the employee's salary, or sorry, wages, hourly wages that went to making what they sold. So we could talk about if say one of the projects that was being worked on was creating different recipes and pulling together the ingredients um, for selling a meal, and say that we hired an employee to do all this preparation work. So the direct material, or say the carrots, that went into creating this meal, and the employees' hourly wage that went into creating these ready-to-eat carrots, those are used to be what we'd call our cost of goods sold that we're now calling variable. Okay, so the only way it hits our income statement and comes off our balance sheet as inventory is if we've sold it. So we have, in this case, we have revenue of 1 million minus our variable costs, which is our direct material and our direct labor. Pretend we're building wagons. So the direct material, all of the materials that we had to use to make this wagon, so all the metal, the wheels, all the parts, um, and then the employees' wages that it took to make all these wagons to give us a total variable cost of 750,000 gives us a contribution margin of 250,000. Okay, and remember the contribution margin is the amount that we have after paying our variable costs that can contribute to covering our fixed costs. Okay, and if you look over on the side where it says PV ratio, that is the profit volume ratio, and it's the same thing as where we did our vertical analysis before. Okay, so if we were trying to come up with the percentage on revenue, 1 million divided by 1 million gives us 100%. If we looked at their variable cost, 750,000 divided by the 1 million gives us 75%. And in this case, the PV ratio that is sitting over to the side is our contribution margin, which is 250,000 divided by our revenue, because everything's divided by revenue, of 1 million. So 250,000 divided by 1 million gives you 0.25 or 25%. So we have, in this exact example, we have a contribution margin of $250,000 or 25%. So our price volume profit, or our price volume ratio in this case is 25%. Okay. So they're going through an example here. Jay Smith's break even. So a taxi driver. I know the slide is really quite busy. Um, don't let it intimidate you. So what they're talking about here is for every $10 in revenue, so right at the top of the screen, you can see for every trip, it's approximately $10. Okay, so for every $10 in revenue that Ms. Smith makes, she has a variable cost of $2. Well, what are the variable costs? You can see here in the chart the variable costs. And again, it depends on, you don't incur the variable cost unless you actually jump in the vehicle and drive. Okay, so the variable costs are directly related to every call you get and have to go pick somebody up. So they're gas and maintenance and repairs. So we've been able to figure out that for every $10 in revenue, we have variable costs of $2. So therefore, we have a contribution margin of $8. And as we mentioned before, that $8, that contribution margin, is the amount that contributes towards paying off our fixed costs. And in this case, you see the list of fixed costs there along the side. Fixed costs are the insurance because we've got to pay insurance no matter what. Car payment, we've got to pay car payment no matter what. Interest, same thing. We've got to pay interest on our car loan no matter what. And we've got to pay dispatch fees no matter what. So that's $15,000 right here. Okay, and you can see that straight line. So no matter what, you've got to pay that 15,000. So how many trips, which average about $10 a piece that we charge, and of course variable costs of $2 per trip, okay, here, and revenue $10 per trip is what we charge our customers. So how many trips do we have to make to cover our $15,000 fixed costs? So look, you take 15,000 divided by $8, and that means that we have to have 1,875 trips, okay, or fares, if that word is used now. I'm not sure if it is. But we have to pick up 1,875 customers if we charge them $10 for each trip. Okay, so to break even, that's how many trips we have to make. Okay, I'm going to end it there because we are at the 8-minute mark, and I will continue on and we'll look at a little bit more on this slide. Thanks, everyone.